3M reports their earnings tomorrow. So getting ahead of the curve here, we are going to dive deep into the numbers of 3M, figure out what they're doing right and what they're doing wrong, and last but not least, figure out the intrinsic value of this company so you have an idea if this company is one, overvalued, or two, undervalued, and if it's a buy today. So here's the story with 3M. Over the last 3 quarters, they've been beating their earnings roughly around 34 cents. They beat it by 6 cents and then by 9 cents in the last reported earnings. As I said, they're reporting their earnings tomorrow, and it looks like they might be having an increase in earnings based off some news articles that have come forward. Now, I'm going to load this company up in the stock spec software. This is a software I like to use to just quickly analyze companies and get the lowdown in a quick and efficient manner. So the software is grading this company an 8 out of 10. Now, what does that mean? Well, that means on the financial basis, on their financial statements rather, they're a relatively strong company. They're only getting docked in 2 different categories. One being the debt to equity ratio sitting at 111%, which is astronomically high. We want to see that number below 50%. And their share dilution, which is up by 0.24%, meaning that they have been diluting shareholders over the last 5 years. 2 things we don't really want to see. So debt to equity below 50% and share dilution, ideally buying back shares if they're cheap enough, or at the very least keeping the share count the same. Now, in that regard, they are doing a lot of things right. Here is the scoop. The price to earnings ratio on a 5-year average is sitting at 21.63. And that means they're not really trading at a premium. We like to find companies that are trading at a price to earnings ratio of 22.5 and lower. The current ratio is sitting at 1.56, so that indicates to us that they have enough assets on hand to cover the liabilities. 1-to-1 ratio is fine. However, we like to find companies, or personally I like to find companies that have a ratio of 1.5 and higher, because that additional margin of safety is key. The return on equity average is 44.65. That's an astronomically high number, more than what we're looking for. 15% is what we're looking for ideally, and it's well above that. And the earnings per share has been going up by 900%, so a massive increase there. On the right hand side of the categories, the net income is up, the free cash flow is up, and the revenue growth is up as well. And the return on invested capital is sitting at a whopping 21% on average, which is great. We want to find companies that have a return on invested capital average of 10% or higher, and they're well above that. So the way I like to do analysis, folks, if you haven't noticed by now, is I like to go strictly through the numbers. The numbers don't lie. The company will tell you straight up what they are doing, and it's up to you, the investor, to figure out and decipher whether it's a buy for you based off what they're showing you. So I like using this financial evaluation section because it just gives me the whole snapshot of what this company is doing. And as I've shown you, it's been a relatively strong company. The one red flag, though, is this debt to equity. I can ignore the share dilution sitting at 0.24%. It is negligible. It is so small of an increase. But we want to find companies that really are leveraging their capital through equity and not taking on debt, especially as a worldwide recession is essentially around the corner. This could be take a huge impact to the business. Now, the company's stock price over the last, let's say, 10 years has been pretty much moving sideways. We hit a pretty decent high on 2018, $250. The 52-week range indicates that as well. Low of $107, high of $175. Currently somewhere on the lower end of that spread there, as we are at $123.22. So the main thing we want to ask ourselves is, what should we be paying for this company today? You know they have strong financials, their balance sheets are strong. So in here in the price analysis section, I've inputted some numbers and different assumptions. So 3 different assumptions here: conservative, moderate, and aggressive over a 10-year analysis. So what this software is going to do is going to price out the company based off my revenue growth numbers, profit margins, and free cash flow margins, and then discount it all back to figure out what we should be paying for this company today. And if you're enjoying the video so far, folks, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. The software I'm using, follow the links in the description box below if you want to try it out for yourselves. 7-day free trial, cancel at any time. With my revenue growth numbers, I try to stay as conservative as possible because I want to have a decent margin of safety going forward. So that's why I did 3, 4, and 5% profit margin and free cash flow margin. Based off the numbers that have been historically given to me by the business, I put a haircut on those numbers, and that only makes sense to me because the more margin of safety I give myself, the more I can trust in the price that's given forward. Same thing with a price to free cash flow and PE ratio. I want to stay, they're well below that premium range. We want to find company, as I said, the company is sitting below that 20%, that 20 PE ratio range, as well as their price to free cash flow range as well. So staying below that with 14, 16, and 18 for the price to free cash flow, and the PE ratio at 8, 10, and 12. Granted, I know it's a $68 billion company. It's an industrial company, so I can't expect this business to, and this business has been around a long time. I can't see this business growing into the astronomical price earnings ratios. Desired return 13% with conservative metrics. Let's see what the software spits out. And guys, it's looking pretty good. With my conservative metrics, it's coming out to be $146.57 on average to pay for this business. So what does that mean, folks? You pay $146 for this company, which currently is at $123. You can potentially expect a 13% return going forward for the next 10 years. So what are my thoughts on 3M? Well, by the numbers, it is an undervalued business. One thing I do want to check out, though, in the free cash flow statement is here. What I like finding companies that have a free cash flow that is incrementally going up. The thing with 3M, though, that's kind of bothersome, and they've been pretty consistent. It's a pretty consistent business. And a lot of people would buy this business for their dividend. As you see, going as far back as 2012, 3.8 billion, 4 billion, 5 billion, 5 billion, 5 billion. I'm just rounding up and rounding down to the closest billion, but it's pretty much been consistent at being at that 5 billion mark. Now we go back to the company metrics category here. Take a look at the dividends that are being paid out. The yield is 4.88%. The dividends being paid out is 3.4 billion, and on average 5.5 billion is their average free cash flow. So if you are a dividend investor, something to keep in mind is, yes, they are able to cover their dividends, and yes, it's currently undervalued based off these metrics. Now, I could be a little bit more conservative with my revenue growth numbers, but where it stands now, it is pretty much there. Ideally, if I were to buy this company, I would like it to go, I can't be really greedy. It's actually at a pretty good price. I think if I were to add this company to my portfolio, I'd be pretty satisfied with this price. But likewise, nonetheless, you have to do your own due diligence, do your own research. This tool here is a great application for you to just get the whole scoop of the company. It comes with 10 years of financial data. And as I said, if you like to get your hands on it, follow the links in the description box below. I feel like you will not be disappointed. So with that being said, folks, that's the video on 3M. I will see you in the next one. Thank you so much for watching.